So last time we talked about the two categories of people that would buy an annuity. Category number one, you're in your 40s or 50s and you want to start putting money on a regular basis, usually monthly, into another retirement savings vehicle that's separate from your 401k and IRA. Something that will give you a predictable monthly income when you're 59 and a half or older, and ensure that you don't outlive your money in retirement. Yes, you can structure an annuity so that you can keep getting a check every month post-retirement and not outlive your money. That's one of the primary goals of buying an annuity, because running out of money is the biggest retirement worry for almost everyone. And if you're younger than 40s or 50s, you're watching this to see whether mom, dad, or an older relative should consider buying an annuity. Category number two, you've received a large lump sum of money and want to exchange it for a steady stream of cash flow. Think lottery, Vegas, an inheritance, business sale, or the most common case, a rollover from a company retirement plan. Again, this steady stream of cash flow should start when you're 59 and a half or older so that you don't incur any penalties from the IRS. Today, in this video, we're going to go through the pros and cons of buying an annuity. For our loyal subscribers and viewers, welcome back. We love you guys. And for those of you new to Diamond Nest Egg, we love you too. And welcome to the #1 place to learn about money, investing, and retirement. I'm Jennifer, and I've spent most of my life in finance. Started working at banks like JP Morgan and Goldman Sachs at the age of 17 and graduated top of my class from NYU and Harvard Business School studying finance and business. And now I work with companies like Bloomberg, WeWork, and Walker Edison, teaching their employees all about financial literacy and education. Please note that Diamond Nest Egg is a financial literacy education and coaching company, and that I'm a licensed life, disability, and health insurance broker. We are not a bank, securities broker, legal, tax, or financial advisor. So some quick basics first. What's an annuity? An annuity is a contract between you, the owner, and an insurance company. Whereas life insurance protects your loved ones upon your death, an annuity protects you and provides you with recurring income, a regular paycheck while you're still alive. It provides income generally during retirement, and it provides this income for a specific number of years, or in the most ideal situation, for your entire life post-retirement, so you don't outlive your money. In the simplest terms, think of an annuity as a way of giving yourself a steady income in your later years, when you're no longer getting a regular paycheck from work. Take a look at our Intro to Annuities video here to learn more about annuity basics, who would buy an annuity, and how an annuity might fit into your overall retirement plan. So advantage number one of an annuity, and the main reason for purchasing one, is guaranteed income and peace of mind in retirement. The insurance company has to pay you the income it has agreed to in the contract, no matter what. And depending on how you structure your annuity, these payments could last for the rest of your life, regardless of how long you live. Keep in mind though, this promise is only as good as the insurance company behind it. The last thing you want is to find out that your insurance company has gone bust when you need your money the most, which is one of the reasons why we only work with the best of the best in the insurance business, MassMutual and Guardian. Guardian was founded in 1860 and MassMutual in 1851. That's before Alexander Graham Bell invented the telephone. Can you imagine how hard it was to do all this before email and e-signatures? Anyway, both Guardian and MassMutual receive high ratings for financial strength from the largest independent ratings agencies, and they've paid out dividends to their policyholders consistently over the years. In 2021, Guardian's dividend rate to policyholders was 5.65%, and MassMutual's 6%. Advantage number two of an annuity is that the money you put into it earns interest on a tax-deferred basis, meaning like your IRA or 401k retirement account, you don't have to pay any taxes on the money that grows in the annuity until you pull it out. Guys, if you're enjoying this video so far or have learned something new, we really appreciate a thumbs up and a subscribe. YouTube loves all this love, and so do we. It also tells us we should keep focusing on retirement to help you build your biggest nest egg possible. Now moving on to advantage number 3 of an annuity. And it's that you can customize it to your needs, much like life insurance. Take a look at our life insurance videos here if you're interested in learning how to protect your wealth, those you love, and build a legacy for future generations. So customizing an annuity, just like you would customize your life insurance. I'm just gonna go into this briefly because I'm sure you're not interested in watching a 2-hour documentary on annuities. But customizing an annuity will be a separate video of its own in about 2 weeks' time. So don't forget to subscribe if you want to hear more about this. Here's a glimpse of the questions you need to ask yourself when buying an annuity to give you a sense of how you can customize it to your specific life, family, career, and financial circumstances. 1. Who are you buying an annuity for? Yourself, your partner, or perhaps mom and dad? 2. Who will be your beneficiary or beneficiaries if you die early? I know it's morbid, but it's something you need to think about. 3. How do you want to pay for your premiums? All at once, like in the case of lottery winnings, an inheritance, or a company retirement rollover? Or perhaps on a regular basis, every month or quarter or year? 4. When do you want the monthly income stream from the annuity to start? Immediately, like right now, or perhaps sometime in the future? And if in the future, when in the future? And probably the most important, 5, when you get your monthly income stream, do you want to get a specific amount or do you want to get paid for a specific number of years? Say 10, 20, or 30 years. Or do you want to be paid so long as you're alive? Right, so we've just scratched the surface on this one. As you can see, there are so many considerations when buying an annuity, and definitely no one-size-fits-all solution. So if this is something you're seriously considering, either for you or for someone else you care about, DM us on Instagram or shoot us an email at jennifer@diamondnestegg.com to see if we can customize an annuity for you or your loved one. So far, we've talked about the advantages of buying an annuity: guaranteed income and peace of mind, tax-deferred growth, and the ability to tailor it to your individual life, family, career, and financial circumstances. Now let's talk about the disadvantages. Disadvantage number 1 are the fees and commissions. Some types of annuities, such as indexed or variable annuities, are quite expensive to own. Fixed annuities, less so. Next week's video will be on the different types of annuities: fixed, indexed, and variable. So you know what to do. For now, all you need to know is that the fees on a fixed annuity can hover up to around 1%, so relatively reasonable, whereas the fees for a variable annuity can be as high as 3 to 4%, or even more per year. So relatively not so reasonable. Higher fees means less money in your pocket. The justification for these higher costs is that the indexed and variable annuities are more complex financial products. And they are. And with complexity also comes certain higher costs. We'll be doing a deeper dive into this next week when we talk about fixed, indexed, and variable annuities. You should also be aware that some agents have been known historically to push the more expensive indexed and variable annuities onto clients because of the higher commissions, even when the products may not have been in the client's best interests. So annuities do get a bit of a bad rap for this as well, and rightfully so. What can you do about this? I'll use my car analogy here because yes, I love my car. Not as much as I love my children, but it's definitely up there on the list. Anyway, here's my answer. Find a non-sketchy agent. And my car analogy, not buying an annuity even though it's right for you just because the agent earns a higher commission, it's like saying you won't buy that fancy Porsche or Mercedes when you can afford it because you don't want the salesperson to make more money from that sale than from a less luxurious car. So you go and buy something that you like just a little less, that's a little less right, just so that the salesperson makes a little less money. Makes no sense. And the same applies to annuities and life insurance and everything else in your life for that matter, assuming you can afford it. If the annuity is right for you, if it fits into your overall retirement plan, and you can afford it, then you should buy it. If not, then you shouldn't. The key is finding an agent that isn't sketchy, that truly understands your individual circumstances, whom you trust, who will find you the best annuity that's right for you. Whoever you're buying your annuity from must have your best interest at heart, what we call a fiduciary in the industry. And when you find that person, you know that he or she will not be selling you an overly priced variable or indexed annuity, because that annuity guy or girl will treat your money even better than they treat their own, and will have an eye on the fees. When you're fiduciary, your client's interest comes first. It's that simple. So go fiduciary, don't go sketchy. Disadvantage number 2 of buying an annuity are the early withdrawal penalties. If you take your money out of an annuity before you're 59 and a half, you have to pay a 10% early withdrawal penalty on any money you take out, plus any regular taxes due on that money. In addition, if you have an annuity that you're making monthly payments into, so not one where you put it in a lump sum all at once, withdrawing the money before a certain period of time will incur what is known as a surrender charge. Why is there a surrender charge, you might ask? Because an annuity is designed for retirement, so long term. And the surrender charge is there to deter you from taking your money out early. So when you put money into your annuity, the insurance company uses this money to buy different types of investments, depending on the type of annuity you buy. If you withdraw your money early, the insurance company may also have to sell some of their investments early and pay a prepayment penalty on that sale, or perhaps even sell the investments at a loss. The surrender fee can be as high as 10% if you withdraw your money from your annuity in the first year, but it does go down the longer you hold onto the annuity, and at some point to 0. But read the fine print and avoid the sketch. Despite these 2 disadvantages, an annuity can be a great addition to your retirement portfolio because of all the advantages it does offer. Guaranteed income and peace of mind, especially in retirement, tax deferred growth, and the ability to tailor it to your individual life, family, career, and financial circumstances. As I already said though, there's definitely no one size fits all when it comes to an annuity. So you know how to reach us or on Instagram if you're interested in designing an annuity that's right for you or your loved ones. Thanks for watching, guys. If you enjoyed this video, please give us a thumbs up and hit that subscribe button. And see you next week for a deep dive into fixed, index, and variable annuities.